Britain didn't conquer the world with gold. It conquered it with debt. In 1694, the crown was bankrupt. Wars were draining the treasury. Taxes weren't enough. So Britain did something radical. It turned national debt into permanent power. And the United States later perfected that system. Today, it still runs the world. Empires do not collapse because they lose battles. They collapse because they lose liquidity. Armies can retreat. Territory can be reclaimed. But when capital evaporates, the system begins to fracture. In the late 17th century, England faced a structural constraint, not a military one, a financial one. War against France required capital at a scale taxation alone could not sustain. Taxes move slowly, war moves fast, and when expenditure outruns revenue, debt begins to accumulate. The problem was not territory, it was funding velocity. How fast can a state convert trust into capital? How efficiently can it transform credibility into liquidity? Traditional monarchies relied on tax extraction, forced loans. Coin debasement, each method solved the immediate crisis. None solved the structural problem. Tax extraction reduced trade velocity. Forced loans destroyed trust. Coin debasement weakened currency credibility. And weak currency is not just a monetary issue, it is a systemic one. Instability weakens currency. Weak currency increases borrowing costs. Higher borrowing costs compound debt. Compounded debt accelerates collapse. This is the mathematics of empire. When interest rates rise, power becomes expensive. When power becomes expensive, trade contracts. Confidence erodes. The system tightens. Most states stretch their existing model until it snapped. England did something different. Instead of extracting more, it redesigned the system itself. Not more taxes, not more coercion, not more debasement. A new architecture of debt, a permanent funding mechanism, a scalable financial system, a structure designed to outlive the war that created it. And that decision would change the balance of power in Europe. In 1694, a structural innovation emerged. Not a new weapon, not a new territory, a new system. The Bank of England was founded not as a building, but as a financial coordination mechanism. It was an agreement, a contract between the state and capital. Private investors lent money to the government. In exchange, they received government bonds. For the first time at scale, state debt became tradable. This was the breakthrough. Debt was no longer a temporary emergency measure. Debt became institutionalized, not hidden, not improvised, structured. Instead of scrambling for liquidity after war began, England engineered liquidity before the first shot was fired. Instead of extracting wealth after conflict, it pre-financed war through capital markets. Taxation was no longer the ceiling. Confidence became the ceiling. Risk was distributed across investors. Ownership was securitized. Liability was formalized. Trust was engineered into the system itself. And when trust becomes systemic, borrowing costs fall. Lower borrowing costs expand capacity. Expanded capacity increases power. This changed everything. France relied on royal extraction. Spain relied on bullion flows. Many empires relied on currency manipulation. England relied on structured debt. Debt became predictable. Predictability reduced uncertainty. Reduced uncertainty stabilized currency. Stable currency strengthened trade. Trade expanded. Revenue stabilized. Interest rates remained comparatively lower, and lower interest rates compound advantage. This was not merely public borrowing, it was financial architecture, a permanent funding mechanism, a liquid secondary bond market, a scalable financial system. Debt was no longer a symptom of crisis. It became infrastructure, and infrastructure scales. When capital can be mobilized faster than rivals, war becomes sustainable. Expansion becomes repeatable. Power becomes systemic. Debt became a scalable system, and in the mathematics of empire, scale determines survival. Debt is often described as weakness, a burden, a liability, a sign that a state has spent beyond its means. In most historical narratives, debt appears at the end of empire as a symptom of decay. But in England's case, debt was not decay, it was design. In this system, debt was infrastructure, not emergency borrowing, not improvised extraction, infrastructure. A liquid bond market created something unprecedented: predictable capital flows, investor alignment, secondary market liquidity. For the first time at scale, state debt could circulate. And when debt circulates, risk disperses. When risk disperses, confidence stabilizes. And when confidence stabilizes, borrowing costs fall. This reduced systemic friction, not just in war financing, in trade, in currency markets, in state credibility. Trade expanded because merchants trusted settlement. Currency stabilized because repayment was predictable. Power scaled because capital mobilization became repeatable. The debt state did not replace monarchy, it optimized it. The king remained sovereign, but the system became structural. The crown commanded armies, the market funded them. And that coordination between sovereign authority and financial architecture changed the trajectory of European power. But every scalable system contains latent fragility. Scalability amplifies strength. It also amplifies risk. Permanent debt requires permanent confidence. Confidence is not stored in vaults. It is stored in belief. If trust fractures, currency destabilizes. If currency destabilizes, bond yields rise. When bond yields rise, interest costs compound. When interest costs compound, liquidity tightens. When liquidity tightens, collapse accelerates. The mathematics does not disappear. It simply reverses direction. The same mechanism that scales power can accelerate collapse. The strength of the system is proportional to belief in repayment, not belief in gold, not belief in territory, belief in institutional continuity. Financial power is not metal, it is credibility. Gold can be seized, silver can be stolen. Bullion flows can dry up, but credibility, once institutionalized, can regenerate capital. England did not become powerful because it was richer. It became powerful because it engineered a funding system that outlived kings. Territory can be lost, armies can be defeated, naval supremacy can shift, but a resilient financial system can regenerate power after military failure. Empires collapse when their debt system collapses, not when they lose a battle, not when they lose a province, when trust evaporates, when currency credibility breaks, when interest costs outrun productive capacity, when the system tightens faster than it adapts. Power is not territory, power is coordination, and coordination requires a system that aligns capital with authority, a system that transforms trust into liquidity, a system that converts credibility into scale. In the mathematics of empire, sovereignty without structure is fragile, but structure without trust is unstable. The most powerful empires are not those with the largest armies. They are those whose financial architecture can sustain pressure longer than their rivals. And when that architecture fails, history resets. Because in the end, every empire is a balance sheet, and every balance sheet depends on confidence.